is to generate an interactive dialogue with you about various aspects of the exit market using the resources we have here on the panel. So what I'd like to do, panelists, is just ask you to each spend a minute, talk about your backgrounds and your recent exit experience, and then we'll have some questions and some dialogue with the audience.
You want me to start?
Yes, please.
Ad Ketelaars, good afternoon, gentlemen, or lady, gentlemen. I see one lady. I studied in Eindhoven industrial engineering 1 year after that Eric started. That's the only reason I'm mentioning it here today. And afterwards worked as a managing director, CEO in many different companies, different exits. To mention a few, in the 90s, I started up Enertel, owned by the utility companies at that moment, competing with KPN. That's why some of these experiences of seller experiences and valuations in the 90s in the telecom world were there. Afterwards started up a few companies, good and bad. Managed Philips Business Communications in Hilversum, PBXs, on behalf of Philips with the objective to sell it. I sold it in 2006 to the Japanese, to NEC, getting into a different corporate environment. Worked for NEC for about 2 years, I guess. Then joined a small company, Cybertech, which is a company in voice recording, call recording for contact centers as well as banks. We decided to focus on banks in that environment. Sold the company in 2011 to Nice Systems from Israel. I'll talk a little bit more about it later on. Worked then for the Israeli for about 1.5 years. By the way, if there's any opposite in the world between Japanese and Israeli, you can imagine the difference in cultures. And for the last year, I've been a mini boomer, if you want to call it that way. I don't recognize any of the trillions that you mentioned. That's it.
Thank you.
My name is Eric van Schagen. I am the CEO of deMuynck in Veldhoven, near Eindhoven, one of the technology cities here in the Netherlands, or maybe even in Europe, one of the main technology cities. I've been working for deMuynck since 1982, so that's 31 years. And maybe I've missed 15 or 20 years that we are over the wave now. So that's something to think about. We are a public company since 1986, so I've been 27 years on the public stock market. And I hope within 3 months that we are a private company again. So I'm busy with the process of trying to get deMuynck from the public stock market again. Besides what I do in deMuynck, I'm an investor in I think maybe 10 technology companies now. Maybe we can even say 15 technology companies, because we are also an investor in technology companies within deMuynck. So I have some experience with participating in companies, but also some experience in selling some companies or some participations. I think in total that we have been participating in 25 companies. And if I look at the total money we have invested there, then it's a lot, but we have sold 3, and that was enough to get back what we invested 2 times. So that's the positive news, and the negative side is that it's, in my opinion, very difficult to sell a company, and that's a little bit contrary to what you showed, Basil. I'm also in the supervisory board of a company or an investment fund called TechnoStars. That's 20 startups, and as I see it now, it will be a small disaster. So that's also an interesting experience. And I think you also learn sometimes from disasters what to do and what not to do, but I can tell a little bit more about that as well.
So, good afternoon. My name is deMuynck. I am from Belgium, but I have both nationalities. I'm Dutch and Belgian, but studied in Belgium. Most of my career in economics and commercial management. The biggest part of my career has been with the Philips company, almost 30 years, out of which 50% abroad. I was for 4 years in the United States, 2 years in Seoul, South Korea, and 7 years in Hong Kong. Fantastic time, both privately and business-wise. Moved to Amsterdam, and afterwards stayed for 4 or 5 years on the board of KPN, busy with mobile. My last job was as an executive, was the sale of Liquavista. Liquavista was a technology display company, spin-off of Philips, owned by a number of venture capitalists, not always aiming for the same kind of exit strategy. So that was a daunting experience as well, but most probably we'll talk about that later. But we sold the company, I think, end of 2009, I believe. End of 2009. And since then, I have a number of board positions with the TomTom company, which I suppose most of you know. With Belgacom, the Belgian KPN, which is still owned for 53% by the Belgian state. So that's an interesting company as well. We recently were in the, before you say it, we recently were in the press because we were cyber hacked by, we don't know exactly who, but powerful people. I'm as well on the board of Teleplan. Teleplan is a company of Gilde Investment Fund, which was taken off the Frankfurt stock market recently, 18 months ago. And I'm a little boomer, we call it, a little boomer as well. So I've made some private investments in some startups as well, which is interesting, you know, seeing the portfolio of somewhat large corporations like Belgacom, TomTom, but then at the same time investing in really startups with 15 people, yes, with a concept, with a product, but still on the verge of to be proven, to get customers, etc., is I think a very nice mix.
I agree. Thank you. I wonder if you could each take a few minutes and share with the audience some of your personal experience with recent exits. And again, what we're looking for is just lessons that you've experienced that you think would be useful and might stimulate some conversation.
Shall I start?
Sure.
So the most, well, not the most recent, but I think the most recent one where we were very active, by the way, Herman Vos, who is in the audience as well, was at that time our financial manager, so we did it together. Was of course the sale of Liquavista to Samsung. In the meantime, the company has been again sold to Amazon. So it sometimes can go quickly, because I'm talking end 2009 and today it's 2013. So within 4 years it had two owners. In itself, I think it was a daunting experience. It was a challenging experience. First of all, to manage the expectations of all the stakeholders. That already is something which I think is an experience which you have to go through. Secondly, to sell a company to Samsung is somewhat exceptional as well. They are not known for making major acquisitions. And I think this was a major acquisition from them, both financially, or well, financially for Samsung, what is major, but certainly strategically. And I think some of the points which were mentioned earlier in the afternoon during the speech of Basil was certainly that it is important at a certain moment that when you say that you want to exit, that you've got everybody who has to be involved on one line. I think that's an extremely important. If you have to manage both the external process of selling, but you have to as well manage internally, you know, all kind of different, extremely important. I think extremely important as well is to take along your shareholders, your stakeholders in the process, whoever needs to know. I think the golden rule is you always think that you've communicated it very well, and at the end you always find that people have not understood it, so or at least not have understood everything. So I think that's extremely important. Point 5, don't get nervous, because you will hit in that process ups and downs. At a certain moment you might get extremely excited because you've got 5 people indeed lined up. And before you know it, 3 of them left and you really don't know why. So don't get nervous. Stay put, make absolutely sure that's what you want to do. And at the end, you need a little bit of luck as well, I believe.
Excellent points. Eric?
Yes, this year we sold a company called Frog Navigation Systems. I don't know whether you know it, but it's a company in automatic guided vehicles here in Utrecht. And it's not true that it can be within 1 year or within 4 days, because I was investing for 20 years in this company. And we have had one controlled bankruptcy in between, so it was a long story. We were first in automatic guided vehicles, and it was going up a little bit, down a little bit, good customers. Then we went to public or to people movers, and that was a big mistake because there was a lot more regulation to that. So we were in fact not focusing enough. That's why we went bankrupt about 5-6 years ago. But we restarted the company, focused on the automatic guided vehicles, and it was, I think, exactly in the good spot of 10 million euros of turnover, about 30-40 people. So we thought before we get to the next difficult step, we try to sell it. So we had a good decision that we took an M&A agent. At this time it was Downer, an international M&A advisor. At the end, they didn't do the job for us. They have advised us. I think the mindset to get it to M&A was very good from that advisor, but they didn't find the good buyer for the company. The buyer for the company was, in fact, already a customer of the company. So, as is in many cases, I think. What Guy said, try to keep cool is very important. So have some patience. And try to get the good persons in the process of selling the company. I said I'm not the right person for that because I like building companies, I like the people part of companies, and I'm not the best one to sell companies. So I took the wisest decision and stayed a little bit on distance, and that was good there. And at the end we sold it to Oceaneering, which is a public company in the United States of $2.3 billion, and they have offered a good price for it. So that is a success story, and that's very important. But as I have told you, of 25, we only sold 3. I think 10 or 15 or maybe even more were just mistakes, and maybe they were mistakes because we didn't define the exit strategy when we were participating. We just found it interesting technology or interesting people, but nothing else. So we didn't define the exit strategy in the beginning. I think that's very important, and I don't say that when we would have done that the exit would have been successful, but I think we wouldn't have participated in the company. That's the thing. So and there are also a few where you maybe have some bad luck, or maybe you are too late with making the decision to sell it on the right point. So I agree with a lot of points that Basil has presented here, and I can add this experience.
Thank you. Ed?
I could talk about misalignment in the case of Enatel, which was about 15 years ago, but the audience here is a little bit too young to talk about that too long. But that was a situation in 30 seconds about 9 different utility companies that all had a veto for every major decision. And we did not discuss exit strategies in the beginning, so it was like a disaster. If you want to know more, Google my name and Enatel and you'll find it out. Everything else was in the public domain. The most recent one, Cybertech, is one that I invested in and became CEO shareholder in 2008, and we sold in 2011. I think that's one where we, from the beginning, more or less, we didn't know you, but tried to figure out how our exit could be. We were also at a model where you would say, well, we were on the steep curve up, but we could see the top of the hill, and we knew that either at that moment we needed to have an exit, or we needed to have fundamentally more money to build a new model on top of the first one. So we tried to raise the money, but then got a call from one of our major competitors. There were two major competitors. And then the important lesson is always to have a plan B and always to create competition. That is the major part. So we needed to make sure that the other major competitor was aware that this competitor was bidding, without being too eager to tell that to the other party. So as we got approached by M&A boutiques that wanted to sell the business, and we had chosen one that would sell us, and then another one came and we told him, no, you can't sell us, but what you can do is you can act on behalf of a buyer. And we can suggest you to talk to this and this and these people as a buyer, so that's how you make them aware. Anyway, the process worked, and we got the competitive situation and sold it ultimately. I think that what for me is always in all the cases is one exit that was a success, but success and failure in exits is very close to, and I guess all of you who've been involved have seen that, things that can break off at the last moment, don't get nervous, but still they can, all types of antitrust regulations that you get at a certain moment that came out of nowhere. I can tell stories about that, but my experience is that success and failure are very, very close to each other, and you need to have your full-time devotion and energy on that, which hurts your position as CEO if you try to do both of them together. I recognize that too.
There were some excellent points there. It's surprising how all three of you had some similarities in your exit experiences. You know, one was the fact that a lot of these were international transactions, almost all of them. I didn't hear any domestic M&A activity. I think that you made some interesting points about alignment in each case, how important that is and how you can't do that too well. I think it was also interesting that there was discussion about the quality of the M&A advisors and how to get the most out of them and maybe not to expect too much from them because they don't always succeed. I think there's lots of opportunities to create some questions out of that. Anybody in the audience want to ask a specific question to any one or all of the panel at this point? Sir.
When you listen to the sort of about the European situation, I think it's not 100% applicable. What's your feeling about it?
Great question. Just to repeat it so we get a good recording. The question was, how does your experience in the European M&A market vary, if at all, from the kinds of things I was saying earlier in my presentation? Does it seem different from your perspective?
Maybe
Anybody?
and of course it goes then directly into the ideas of, to which we were exposed earlier today. I do strongly believe that indeed an exit strategy is needed, and it can't be just a coincidence. You have to plan it for. It is a process. You might argue, and maybe that's not even so important, whether or not it's the most important process or it's the most important part of the CEO, whatever. But I do believe that it is important that once that you feel that the time is right, and we can debate as well when is the time right, but let's assume that that's the case, then indeed you have to have an exit strategy, and you better can start earlier than later. It can't overwhelm you. It can't overcome you. You have at a certain moment to take the lead. I think the picture which I think was a little bit shown this afternoon might be different from in the United States or Canada might be somewhat different from Europe. My own experience today is that it is not so easy to sell companies today. We saw the enormous amounts of cash being stacked on the balance sheets of the Googles and the eBays and the Amazons, etc., etc. But my experience is that it is not because they have money that they will buy whatever. It's not the 2000 years anymore, at least in my experience, where around the boardroom people said we have money and we have to do something, doesn't matter what we do, but we have to do something because everybody is doing something. That's not the case, I think today. Certainly not in Europe, and I don't think it is the case today in the United States as well. So to a certain extent, I would like to mitigate a little bit and to balance a little bit your story. That I think the fundamentals of the company are still the most basic ones to sell it on, which is a good business plan, customers, a good technology, look for the synergies with your prospective buyers, but you have to have some solidity. You have to have some basis before you can start, but then indeed plan for that process. So that might be somewhat different from your experience recently in the United States.
Yeah, maybe I see a difference between the American situation and the European situation in this way that, as Basil told, a lot of American companies believe that innovation can be better done by small companies, by startups. And I think almost all of the European companies, the bigger European companies I know, they think they are better in innovation and they are better in R&D. So a European company will almost never buy a company which doesn't have any turnover or any proven customer base, EBIT, so they don't buy concepts. And when I look at a company like Oceaneering or like Cisco is a very good example, they see an innovation, they see the market for it, and they are prepared to buy earlier stage than European companies are, in my experience.
Yeah, I think there's a number of different things. First of all, the Americans are just more aggressive, more drive, more guts, and for me, for the better. I mean, I think that we should take that. But what they also have, they have more scale. So if they buy a $20 million company, then they buy it because they can think they can scale it. And if you in America, it's just much easier to scale the business than it is in Europe. There's lots of different situations where that scalability, that easiness of scaling it out to Europe in languages, in cultures, in parts is just much more difficult. So that's why I think that's something we have to live with in a domain. The other thing that I wanted to mention is, in terms of cultures, is the Israeli culture. It's something that if you have a chance to read a book called The Startup Nation about Israel and how they started up and what created that environment, I believe it's something like 1/3 of the gross national product of Israel is done by selling companies that they started up and selling it to Americans mostly. So if you want to see something about drive and culture and can-do attitude, that's really where things are. And I think that we need that in Europe. We need to live with the fact that we can't scale that easy, but we need to compensate it by even more desire to achieve. Let me put it that way.
Excellent points. And maybe if I could just add briefly to your question. I think that if you're selling a company, I think your opportunities here are similar to what they would be anywhere in the world. Because I see on the acquisition side, companies that are buyers really don't care much about geography anymore. They will take a global perspective to each company or type of company they want to buy. I also see good M&A advisors, when they find a company that would like to be acquired, literally survey the whole globe. So I think that on the selling side, we're already working in a global market. But I agree with Eric's point about the companies here in Europe, I think are a little behind what we're seeing, for example, in America, in accepting that innovation is better done by startups. 10 years ago, it was much the same in America, in my experience. The big companies still thought of themselves as innovators. Their CEOs would still talk about being innovative companies. Today, they don't say that anymore because everyone knows it's not true. And I think here in Europe, there's been a long history of some of the great companies being very innovative. But as we've seen recently with Philips, as things have evolved, we see a lot of layoffs in the Philips R&D team. Well, I think that's the beginning of the process we saw in America a decade ago. And I think that they will inevitably see that they're not as able to develop internally as they once were. And I see Philips, for example, as being very active in the M&A market already. They're out buying anything in the lighting business. They're very aggressive acquisitors worldwide. So I think maybe what we're seeing in America on the buying side is just a little bit further along, but I think the same global trends apply. And I think Ad's point about studying the Israelis as a good example is an excellent point that I often make myself, because if you look at them just objectively, they're not in a particularly desirable or stable part of the world, and they've got a lot of things going against them. But in the M&A market, they are very aggressive buyers and sellers. And so I think they illustrate that anything, you can overcome distance and geography and a whole bunch of other things if that's the country's strategy and if that's the will of the people in the country. Great question, thank you. Other questions? Sir?
Basil, you started the day with saying when you invest, you don't want to lose your money. And I heard a remark from Eric van Schagen regarding startup investing. Can you explain a little bit how you handle this process of investing and not losing your money in early stage companies?
An excellent question.
Yes.
Who wants to lead off with that one?
Well, I think from the experience I have had the last 10 years, you are trying to look a little bit what is successful or what has a chance to be successful and where you almost always lose your money. And I think when I look at startups right now, I think there are two things where I say they are, for me, crucial whether to invest or not to invest. And one is you need the brightest people. Sometimes you see that startups or other companies, they ask for money, but they don't have real bright people. They have maybe business people who can do something, but you need real bright people to have a chance. And the second one is that I think in a company you need IP. They need their own product. Don't invest in startups, in services, or that's my feeling about it. So you have then still maybe 5 out of 10 will fail, but the 5 that will survive or that will be successful, or the 2 or 3 will compensate for everything you have invested. So bright people, very bright people you need, and they need a product where there's real innovation and IP in the product, so that you are not dependent on only people as a service. That's my experience.
To add to what Eric is saying, I think you should start from the assumption if you invest in 10 companies, 2, maybe 3, if you're lucky, 4 will make it and 6 will not make it. I mean, either you're much more smarter than anybody else, but if you feel that you can increase the percentage, it's going to be difficult. But I think what you can manage is 2 things. That's number 1, very carefully listen as well and look at the signs of the responsiveness you get from your customers, people involved with the company, in the industry, etc., etc. And I think the biggest mistake you can make as an investor is to stick too long to your investment, i.e. to continue to invest. If you find the signs and if you really make the test of reality and you find out that it is not working, don't be ashamed to say the buck stops here. Because I think that will limit your downside risk. Trying to get the percentage up is going to be very, very difficult, not impossible. But I think what you could do is, if you're a careful listener, you want to be seen as a realist, and at a certain moment take that input and say, till here and no further, then I think you can manage your downside risk.
Excellent point. Do you want to add anything to that?
Sure, always. So first of all, there's more people here that know much more about it. I see Floris and Robert there that can talk a lot about generic statements than I can. So I talk about personal experience. I think it's key, the people. You have to like them and they have to be good. That's how it starts. But secondly, I think it's a very early contact with customers. If you're in the startup, talk to customers and find out what they say and what they think. And don't be afraid to change the business model based on those discussions. I've seen it now with a couple of different situations in smaller companies that we are changing the business model completely after a couple of months of discussions with customers to another model in another way. And you have to have that type of flexibility to make sure. So you have to also, you cannot be just an investor and just wait to see what happens. I mean, it has to be talking to customers together with management and think about it and adapt it if needed, the model.
Those are really good answers to a fascinating question. And I think it's a good question because at this point, I don't think anybody has all of the answers. You know, when I was a young entrepreneur, I watched the old venture capital industry trying to discover their best practices. It took them a couple of decades to get to the point where most venture capitalists globally use pretty much the same best practices, even to the point of using the same investment agreements. Well, what's interesting is that model that they optimize has changed. So the venture capital funds of today are also trying to find out how to invest at the same time that the boomers are getting to be of angel investing age and capacity. And as we've heard from Eric, a lot of companies are also making early stage investments as a way to revitalize and to stay innovative. So I see all around the world now, everyone asking that question of what are the best practices? What can we do to improve our investment returns? And you know, how do we learn those things? And I think it's a question that we'll be asking for a good number of years as we globally find ways to invest in this new generation of companies in this new economic reality. Let's have some more questions. Those two have been excellent. What else could this panel help you with? Anybody? Hi.
If we all go for early exits, we still need VC.
It's a great question, and I'm being set up here a little bit because when you read early exits, you can see that I take a pretty dim view of the traditional venture capital industry. And I did that in part because I started a venture capital fund. I ran it for almost 5 years, and it took me that long to really understand what was happening in the market. I think that what's also happening today, though, is the venture capital industry is redefining itself. And what we're going to be seeing in the future and what we call venture capital will be very different than the traditional California model. So I think it's a question, it's an open question, but I'd be very interested to hear what the panel thought about whether we still need VCs at this point in the economic cycle.
I think in two ways we still need VCs, or they can have a very important role. First of this is I do some investments together with VCs, and I think this combination can be very good. We do more the customer, the product, and the people side, and they do the more formal side, making good shareholders agreements, looking at the more formal side of the investment. So I feel there that we are very complementary in doing the investment. And in fact, the best examples where we had good return on investment are those cases where we did it together with a VC. So it's also to protect you as an informal investor against your enthusiasm to go into it. So the combination informal investor and VC can be very good in many cases. That's the first thing why I think we still need VCs. And the other thing is that I think that a lot of informal investors, at least here in the Netherlands, as I know them, they are limited to 1 million, 2 million, or even less. So that's almost the limit where informal investors are still prepared to invest, especially when it's a little bit outside their core business. And in many cases you need for the second or the third phase, you need investments of 5 or 10 million. And I think there, when the product is a little bit proven, when you need more working capital, especially in these days where the banks are difficult to supply the working capital even in the second or in the third phase, that venture capitalists can be very helpful when you are in the stage of bringing the product a little bit more to the market. So that's two reasons why I think VCs are very important also in this time.
Anybody else?
No, I think I fully agree. I don't think it's. I don't see directly the correlation between early exits and the existence of the VCs. I don't see that directly, that correlation. I mean, maybe that the cycle will be quicker, but I think there still will be a need for reasons Eric just explained for venture capitals. So I don't see that connection between an early exit and the determination to get an early exit and the necessity for venture capitalists.
I agree. I think the VC money is still needed to bring it up to the $20 million value if you don't have enough informals and others to get it. I think your observation of a VC being more operating as a private equity company and owning 100% and taking the horse and throwing away the jockey, if I understood it correctly, is interesting. I think that type of hands-on help is more needed than ever. Whether it's a VC together with an informal or others, but that is, I think that's the key to success also, that type of attention to the company.
And when you think you need a VC, try to get him to catch the VC in the first phase, because if you are over the first phase and you really search for money in the second phase, it's very difficult with VCs. That's my experience there. Try to catch them a little bit also in the first phase, because they will be a little bit frustrated if they go to the second phase and they wait for a few months, and then maybe for 6 months or 9 months, and then it will be very difficult with only the informals to get the finance together. That's my experience.
Other questions for our panel? Well, let me pose one then. One of you is the CEO of a public company. I'm just curious, what the perception of each of you is about the pros, cons. What does the public market look like? And especially Eric, you were mentioning you were going to become not a public company if you have your way in the next little while. It's a fascinating trend that maybe can shed some light on that for the audience.
Yeah, well, being in the board of a public company is not real fun at this moment. But I've been there for 27 years, so you know the tale of the frog. If you jump in the hot water immediately, it is you jump out of it immediately again. But if you are just being cooked in 27 years, you can do it. So the public company 27 years ago, the whole governance and everything to it was much easier. We had a year report of only 16 pages, and now it's really from a legal and a financial and a formal standpoint really difficult. So if somebody thinks of doing an IPO or getting public with a startup or a company, then I really advise to rethink it a few times, because it's if you don't grow, I mean, an external shareholder which will buy or consider to buy shares of a company like deMuynck, 1,000 people and 200 million turnover, they buy the share because they think, not because they get 3% return a year in dividend or something, but they think, they hope, that within 2 or 3 years it will be double, triple, or even more. And after 2 months, when nothing happens with the share, then they ask you for a plan to grow by 2 times, 3 times, etc., etc. So the pressure on growth from the external shareholder will be unbelievable, and they...
It's your shareholder.
Yeah, shareholder. So and if you don't succeed, or if they don't get response from you, they will search for anything in the press or any way of trying to push you to do something to have it double or triple. And this pressure is not good for the growth of the company, I think. So that's my experience there. And I think the public stock market is in fact most of the times only for the big companies.
I'm a member of the board of an American company listed on the NASDAQ for 10, 15 years now. And if you see what is happening there, I'm trying to avoid being a member of the audit committee all the time. It's tremendous the type of pressure you get from the audit committee, from the desires to follow the rules. There's one of the other members is a lawyer, of course, and I keep on telling him, if you ever go out of the board, I will go out, because this, for me, he needs to keep everything in. There are shareholders that send letters. There's saying you have to do this with your cash, or you have to do that, and if you don't do this, you're liable. And if you, it's just a whole process of, meaning being liable in the US means something. You can. So for me, it's not fun to be a member. And so from a corporate perspective, I would completely agree, don't get into the public part. It's much more fun in the private equity world.
Especially these days.
Yeah.
Anything to add there?
I think it has its values as well to be a listed company, and of course its challenges. But at the same time, I believe if you have a good strategy, and if you have explained it quite well, then I feel in balance. There is nothing wrong with being on the stock market. Yes, you have to follow the rules. Yes, there are more rules. Yes, you have your quarterly reports. Yes, you'll have to manage all your stakeholders. You'll have to manage your communication. You have to be more careful of what you're saying, and maybe sometimes what you're not saying. But all in all, I think it has some merits. It has some merits as well. I think it's not a clear cut of saying, it's only for small companies or to be not on the stock market. Sometimes there is a need to get more capital from the stock market, so there is a good reason why you go out. If you can't find it elsewhere, then you go to the stock market. You do your IPO. Sometimes it's as well a reason why founders at a certain moment do an IPO is. I was involved at the beginning with the IPO of TomTom, and I think it has been, at least for the founders, a very good case. So,
Other questions for our panel? Anything at all is fair game. Sir?
You talked a bit about the timing of an exit. Of course, when you show a graph like that, it's easy to determine the optimum. And in hindsight, it's always easy. Is it possible really to predict in 18 months ahead, before the moment comes, what the optimum will be? And what signs should you be looking at?
That's a very good question. Maybe I'll just lead off and then you guys can add to that. Of course, it's not possible to predict with precision. What I was hoping is that I could get more CEOs and more boards to think about it. And I think that the greatest, one of the things you don't want to do, one of the mistakes I made several times in my career, was not even to ask the question, not be thinking about when is the value of this business going to peak. So what I'm hoping is at least if we think about it, we'll get closer to that optimum. And some of us might even get lucky and hit it right on the top. Anybody want to add to this whole question of?
Yeah, I think, in the case of Cybertech, we kind of, we invested in the market. We were better placed at the competition, lower price, etc. But we're selling software, so price is something elastic if you in that market. We grew the business, but the competition started to note it, and they were much bigger, and they could basically take businesses for a much lower amount, and we would be out of business at a certain moment. So we saw coming that would be in the next 1 or 2 years the case. So either you change your business model, you add something to it, or you exit before that. Of course, being ambitious, you want to add something to it, so we chose that road, but got into the exit mode. And I think that if you know your business, you understand a bit, never exactly, but you understand when your business model will face increased competition and there will be more issues. And I think that's basically where you want to position it for. So I think you can.
Yeah, I agree with the model that Basil has showed, that in most of the cases we are a little bit too late, or maybe even years too late, in trying to sell a company. And I'm a strong believer in not only maximizing the shareholders' value, but also looking at customers and employees, etc. And when I think of it, I think it's even in the interest of the employees, when they are enthusiastic and growing and having a good feeling about this, then it's maybe also there for the employees and also for the customers. The best time to sell a company is when you are going to the upside. So that is what has been shown. You see not only in the value of the company after 3 or 4 years that is going down, but you also see that the employees that still have to give the same thing and are not coached anymore in the right way, that after 3 or 4 years, when the growth is flattening, then the employees, the people are not of the same. They don't get the same chances by the buyer than what they would have had a few years ago. So it's not only in the interest of the shareholder, but also in the interest of the customer and of the people.
For me, the inflection point is when I cannot prove to myself, i.e. the board and the shareholders anymore, that if they would invest $1 in that specific company, which hopefully will get them a return on investment, if that return of investment would be lower than if somebody else would make in the same company that $1 investment and would get a higher return, I think at that time it's time to say, let's better sell it. So even if you have the money, but you can't prove to yourself, to the shareholders, that the return on investment they will get from the money is higher than if another company would invest the same amount and they get a higher return, I think at that time it's time to sell. That would be for me the point of saying that's when you have to do it.
Fascinating answers. You guys are more confident in that ability than even I am, so thank you. Other questions? Sir?
The world's, this is a Belgian question, the world's largest ICT companies have huge brand value, premium brand value. And you can see that very often in the price-earnings ratio and in many other ways. My question is, from what stage on do you think brand value is important for a startup or early stage company?
It's a very good question. Anybody? I'll start if you want.
Yeah.
You know, I see very often companies that get to a certain stage where they've proven the business model and they realize how big the market is. And when they see a market that might be measured in millions or tens of millions of users, I think that they're at a point where, regardless of how much money they have, they need one of those brands. Because if you want to take something and scale it up that fast, there's no way to do it without an established brand and base. A good example that I used earlier was a company called Flickr, which was a Vancouver company that built the first sort of photo sharing site. Like a lot of Canadian entrepreneurs, they were early in seeing an application of the technology, but I'm sure that if they had held on to that, instead of selling it to Yahoo early, they would never have scaled it. Because after seeing it, anybody could have built a similar photo sharing site in a couple of weekends. And the skill or the luck that that company had was realizing that Yahoo had 10 million users. Yahoo could send out emails to 10 million people the next day saying, here's your free photo sharing site. And as a result, that became the standard. I don't think anybody that didn't have a brand like that could have pulled the same accomplishment. Anybody else thoughts on that?
Yeah, the thought I would have is, I think it's going to be, certainly if you are in the more mass market consumer application services, I think it will be extremely difficult to really, from a startup, and of course there are always exceptions, but I think it's going to be extremely difficult from a startup to really make on a quick, just because of the money, on a very short notice, to make really a big brand out of it. So in most cases, yes, you see that at a certain moment, just because of the money and the competition going on, you just can't compete with the stack of money certain companies in the ICT world, but as well in other worlds have. You just can't compete because of lack of resources. And of course there are always exceptions, but
it's not a question, it's more a remark for me. That element of branding affects one of the advantages of an IPO.
yeah.
I'm indeed a strong believer that trade sale is exiting of this more interesting for shareholders. But the marketing value that an IPO can bring to a company is very attractive. It might be a reason to go IPO instead of getting fucking directly.
Very good point.
Yeah, I agree with that, and that's also coming to that question. If you are more in the business-to-business market, you will always find with an innovative product or system a first customer which is also innovative and which will work very closely together with you. But to really enter the market, then you get a lot of questions. Are you still there in 5 years or in 10 years? And that is the moment that you need either an IPO or a bigger company which will buy you to really get more customers prepared to buy your system or product or solution.
There's a question in the back. Sir.
Well, more observation. I agree with the fact that you say the average value of companies is like 15, 20 million. But if I take the analogy that you say you sell early, then Tesla, for example, would have sold 5 years ago to General Motors. And I think they're now a great point. Just because of the fact that they are taking big ideas and great ideas. A company like Flickr, there's a lot of people that do that. So I think aspirational, it's very easy to sell.
It's a really good point, and I think that one of the difficult parts of developing corporate strategy is that there are always exceptions to the rule. I think Tesla's a good example. I think they did the right thing by not doing an early exit. I agree. But I think that where I'm trying to help people think about some of this is that the media distorts our perceptions, I think, to favor the outlier strategies because they're the exciting stories. And I think that for 99.9% of companies, hanging on, trying to do the IPO isn't as likely to be successful. And so I think it's really the skill that I hope we all get better at is learning to weigh those options for each of our companies. Anybody want to add to that?
No, I think I agree. Mm-hmm. I agree.
Thank you. Next question. Sir.
Got a question from the buy side, be more for Guy and your views at Bellingham. You mentioned Basil that the sweet spot is around 15, 20 million, which I would agree. My experience as a telco, most of the acquisitions I've done were around that ballpark figure, too small, too difficult to really handle, and too big to complex, basically. Is that also your experience with Bellingham, that you would say this is kind of the ideal transaction?
I think it would be mixed. It would be mixed, but what I do see is that, and I think it comes back as well to where innovation is, what I do see is that larger companies at a certain moment don't go anymore for 100% acquisition, but will go for a stake, most probably in a company, in an innovative company. In most cases what they do as well, they not necessarily put it immediately in a division, but they'll keep it on a corporate level. They'll follow it up, and at a certain moment they see that it is indeed offering them what they were thinking of, then they'll buy the other stake, most probably had an option to do so, and they'll acquire then the whole company and then put it somewhere in a division. I would not say that Belgacom, for that matter, but as well for other companies, do at a certain moment cap an acquisition for, I think if at a certain moment they feel it's right and the price is right and it really can add value, then I think large companies are more willing to do that as well. But if I look at the innovation, there I think it's the dangerous point about a small company in a big company is that for all the good reasons you bought it, after 15 months you've forgotten all the good reasons and the company is kind of in a blanket. All the good things about that company has disappeared because you got the management layer, you got the complexity, you got the formalities, you got the bureaucracy, and these people, they're not surviving. They're entrepreneurs, they're not surviving, and all of a sudden, you know, the value is lost. So therefore, I see often that they put it away from that overall general kind of, and they put it away in a, not put it away negatively said, but they put it somewhere where it can indeed flourish. But I would not, if that's your question, cap it at a certain moment on a certain number. I mean, to the point, I think we all are experienced some dramatic things. I think you mentioned Nortel in Canada, but we got recent examples. Look at Nokia, look at BlackBerry, research in motion. Who would have thought 10 years ago that this would happen, either with Nokia or with BlackBerry, research in motion? The debate is on, I think, whether or not Microsoft at the same time, you know, announced that they will have a major share buyback, which for me is a kind of exit as well. Huh?
Yes.
I call that an exit because they don't know what to do, so they'll give it back to the shareholders. So it's for me as well an exit. So there are very interesting things, even with large corporations, ongoing as we speak today.
You know, it's an excellent point, Guy, that you make about these big companies changing so rapidly. And just to add to your example of Nokia and BlackBerry, RIM, what has accelerated the demise of those companies is the Android operating system, which now I think is like 75% of all of the mobile operating systems are Google's Android. A few months ago, I sat on a stage like this in Silicon Valley, and I sat next to one of the people from Google who buys companies. And as I said before, I'm very grateful to Google for being so candid with all of us. And the lady I sat next to used Android as an example. And her point, which shocked me, was that she admitted that when the founders of Android came with their very good investment advisor, investment banker, M&A advisor, this was a key point, they had no idea that they wanted to be in the operating system market. So the idea came from the entrepreneurs. They brought it to Google, another good example of when do you need the big brand. And now it's the dominant operating system, and now we don't have so much wealth anymore in Nokia or RIM shareholders. So it wasn't the big company strategy, it was the entrepreneurs that made that difference. Again, I think an interesting illustration of how the 21st century is different and how things are happening faster than we would have ever thought before. Other questions?
Maybe to make a point on the purchasing of $50 million companies. My observation is if it gets integrated, the second part is the integration into the corporate environment. And what I've seen is that the corporates buy it then for product development, that stays. But basically everything that has to do with infrastructure, admin, HR, IT goes away. The CEO, if he's been instrumental in product development, he can stay on for a while, and if not, that goes away. And the salespeople in general are kept, but they go away by themselves because they feel that the environment is completely different. So if you're an acquirer of that type of company, you acquire it for the product, for the horse, if you wish, for the product that goes there. And I think that's the key part. And also, if you're contemplating your exit, that's what, if you're focused in your product, that's what the buyers want. Focus in product that fits into that strategy, and everything that is around it, they throw away anyway. That's my observation.
Really good point. Maybe let me ask the panel a question. And I think that, especially in this business that we're all trying to learn to be better at of selling companies, It's the actual life lessons and sharing those that's most valuable. You can't go and buy some books or take a graduate level course on M&A transactions. It doesn't exist. So I think that the best learning that we can do is exactly in an environment like this, where some people will be willing to share the things that they did wrong in their own recent or first exits. And I know in my case, my biggest regret is that I didn't have a view to when the optimum time to sell was. Our board never even discussed the exit strategy for over a decade. And I ended up selling my first company far after the top in value. And that was the first time that I noticed, several $1 million of personal loss, and that kind of sunk in a little bit. And so if I could turn the clock back, that's the thing that I would have done differently, is thought about it, talked about it, focused more on the exit strategy, and hopefully would have hit it closer to the top. But what would each of you do if you could turn back the clock and take what you know now, what you've learned? How would you do it differently to get a better outcome?
Well, I'll tell my Enetel story anyway then. So we had 9 shareholders, utility companies, each had a veto right, but we were a fixed telecom, so we needed to go into the mobile telephony business, but we didn't know anything about it, so we wanted to merge with somebody else. But all the shareholders had their different games and the different strategies and different parts in this. So at a certain moment, our independent board said, you're allowed to do a management buyout and then do something different. So we organized a management buyout. We offered, the utility companies had invested 75 million guilders. We offered 180 million guilders after 2 years, which I thought was a reasonable return for them. Of course, not our money, but London money. And there was this evening that I remember that we were kicked out of the shareholders and board meeting because they were going to discuss our offer. And at 11:30 or midnight, they came back and they said, we've decided for somebody else. I said, what do you mean decided for somebody else? There's no other offer that I am aware of. And then there was this company, Worldport from the US, that offered 165 million guilders. I said, it's less than we offer, so why them? And they said, well, they're further along. I said, how can they be further along? I'm CEO, I don't know them. They don't know any of the companies. No, they're further along. So we had a press release, or no, press conference with about 10 journalists a couple of weeks later to announce this. And at the end of the conference, one of the shareholders gets up and he says, can I say something? And I thought that he was going to thank me or say something nice or whatever, but so I've learned not to be too naive. And he basically said, no, I want to make an announcement because the Worldport that's buying is a holding company, and we and 2 other shareholders are investing 10% in that holding company to take over the company. So it was their own game, basically. At that moment, one of the journalists asked me what I thought about it, and I said, well, this is completely new for me. Of course, it was my end. The story goes on. They bought it for 165, and 1 year later sold it to Energies from the UK for $1 billion. 2 years later was worth again 100 million or something like that. So that was the 90s in that situation. What I've learned out of it, you better know who your enemies and who your friends are in these type of situations.
There is a valuable lesson,
yeah.
And timing is everything.
Right.
Yeah, I keep it short because I see Peter saying time is almost out.
This will be the last one.
But I learned 2 things today, and that's one, to define an exit strategy once you immediately when you participate, and 2, put it on the agenda almost all meetings. I think this is really a good thing, and I think it's important to get an exit strategy is not something dirty or some people think maybe that way, that's only for the money, but it's good to talk about it regularly and not once a year. But yeah, like we do software development now, we call it scrums every day, 15 minutes scrum. So I think we should scrum in exit strategy.
Excellent. Guy, last word.
Yeah, I think if I could mention certainly one mistake I've made in an exit is underestimate the emotional value sometimes which there is with the founders of the company. Even if at a certain moment they see the dollar signs as well in their eyes, there is much more specifically with the founders than just the dollars. And if you are too clinical in the process and you don't get them along, you can be surprised. And I was at a certain moment, not with the recent one, but with another one, I was somewhat surprised here. So I underestimated completely, which I learned a lot from.
Excellent, thank you. Ladies and gentlemen, please join me in thanking our panel for their contribution this afternoon. I hope you found that as valuable as I did. Thank you.